All right, we're going to deconstruct one of the most fundamental, but let's be honest, least understood concepts in big-time development, the money. Specifically, how do you even get the massive pile of cash you need to build a skyscraper? How is it all put together?
You've probably done it, right? You're standing at the bottom of some gleaming glass tower, you look all the way up and you just think, who pays for all this? It's definitely not one person writing a giant check. The answer is actually a complex, layered financial structure. And it's a puzzle we're going to solve right now.
And the key to that whole puzzle is this thing, the capital stack. I mean, this is probably the single most important concept for understanding how commercial real estate gets built. If you think about the architectural drawings as the physical blueprint, the capital stack, that's the financial blueprint. It tells you where every single dollar comes from and, way more importantly, who gets paid back first.
So, to build our skyscraper, we have to start at the bottom, right? With the foundation. Well, in our financial blueprint, that foundation is called senior debt. This is the largest and by far the most secure piece of the entire structure.
This is where we really define what safe means in the world of finance. Senior debt holders are first in line, period. They have what's called a first lien mortgage. That means if things go south, they get paid first from any sale. And if the developer defaults, they can actually foreclose and take the property itself. This top-of-the-list priority makes it the lowest risk part of the entire deal.
And because it's the lowest risk, you can probably guess, it also offers the lowest return. We're talking a target return somewhere in the neighborhood of 5 to 6%. So this isn't some get-rich-quick investment. This is the slow, steady, and really secure money that forms the base for everything else.
But here's the thing. Senior debt almost never covers the whole cost of a project. So to build higher, you've got to fill that funding gap. And that's where the middle floors of our financial skyscraper come in. Mezzanine debt and preferred equity.
Now, mezzanine debt is where things get really interesting. It's riskier than senior debt because it only gets paid after the senior lenders are totally paid back. And check out this key difference. It's often not secured by the property itself, but by a stake in the ownership company. It's this crucial middle layer that's willing to take on more risk for a better potential payoff. And this just perfectly illustrates the risk-return trade-off, doesn't it? For taking on that extra bit of risk, mezzanine lenders are expecting a much higher yield, usually somewhere in the 8 to 15% range. You can see how as we move up the stack, the risk and the potential reward climb right alongside it.
Sitting just above that mezzanine debt is a kind of hybrid player, preferred equity. Now, it's technically an ownership stake, but it acts a lot like debt. See, these investors get what's called a preferred return, which is a fixed percentage they are owed before the main owners, the common equity holders, get anything at all. It's just another clever tool to bridge that funding gap.
And that brings us all the way to the top of our skyscraper, to the penthouse. This is common equity. It's absolutely the riskiest spot to be. But you know what? It also has the absolute best potential view of the profits.
So, the most important thing to get here is that common equity investors are dead last in line. If the project loses money, they absorb the very first losses, and yeah, they can be completely wiped out. But, and this is a huge but, if the project is a home run, their upside is literally unlimited. This is typically the developer's own money, their skin in the game, and that's what gives all the other lenders confidence.
So to justify taking on all that risk, these equity investors are targeting much, much higher returns, often 15 to 20%, or even more on a really successful project. Sure, they get the leftovers, but sometimes the leftovers are the best part of the whole meal.
Okay, let's make this totally real with a classic $100 million project. You can see the structure is dominated by that big, safe piece, $60 million in senior debt, a full 60% of the stack. Then you've got your gap fillers, $15 million in mezzanine, $10 million in preferred equity. And finally, you have that crucial $15 million slice of common equity right at the very top. This, right here, is basically the financial DNA of a modern skyscraper.
So really, it all boils down to this fundamental trade-off. Debt gets paid first, gets a lower, fixed return, and takes on less risk. Equity gets paid last, has unlimited potential return, and takes on the most risk. Every single major real estate deal is built on this exact dynamic.
So now the building is up, it's successful. How does everyone get their money back when it's sold or refinanced? Well, the concept is called a waterfall, and it's a perfect analogy for how it works. Imagine the cash from a sale flowing down from the top, filling each bucket in a very specific order. First, every single penny owed to the senior debt holders gets paid. Once that bucket is full, the water spills over to the mezzanine lenders and they get their share. After that, the preferred equity investors get their investment back plus their promised return. And only then, whatever's left over, if anything, cascades all the way down to the common equity holders.
Now here's a slightly more technical but really brilliant way to think about this. The equity position is a lot like a financial call option. So what does that mean? It means the equity holder has the right, but not the obligation, to pay off all the debt and keep the property. Their payoff is whatever the building is worth minus the debt or zero. If the property ends up being worth less than the debt, they can just walk away and the lenders take the building.
Of course, lenders don't just hand over tens or hundreds of millions of dollars without checking the blueprints very, very carefully. They've got their own tools to measure the risk of a project before they commit a dime.
They mostly rely on two key metrics. Loan-to-value, or LTV, compares the size of the loan to the property's actual value. A lower LTV means there's more of a protective equity cushion. And then there's the debt service coverage ratio, or DSCR. This just makes sure the property's income can comfortably cover its mortgage payments. For lenders, in both cases, lower LTV and higher DSCR is always safer.
Okay, let's zoom out for a second. Why should you care about any of this stuff? Well, because the way these capital stacks are built doesn't just affect one building. It affects the skyline of our cities and the health of the entire economy through something called the leverage cycle.
And it works like this. In good times, credit is cheap and it's easy to get. Lenders are willing to fund a larger chunk of projects, capital floods the market, and you see construction cranes everywhere you look. But when the economy turns, credit tightens up and fast. Suddenly, it's really hard to get loans, financing for new projects dries up, and defaults start to tick up.
And this really is the ultimate takeaway. The capital stack is the engine of the real estate cycle. The availability of debt and equity, the willingness of investors to fill each one of those layers, is what fuels the booms and what causes the busts. It's the reason real estate can be so much more volatile than the rest of the economy.
So the next time you look up at a skyscraper, you'll know it's so much more than just steel and glass. It's a carefully balanced, sometimes precarious, stack of capital. It's a structure that builds our modern world, but it also raises a really crucial question. Does this constant reliance on leverage mean that inside the foundation of every boom, we're also planting the seeds of the next bust? It's something to think about.